welcome to today's webinar on the investment life cycles of startups. Basically, what goes on into planning your investments. I'm Hormuz Charna. I'm the founder and CEO of MergerDomo. We're an online investment banking marketplace where we help SMEs and startups in their organic and inorganic growth journeys. To start with, I would like to thank our partners, Mighty Startup Hub, for giving us an opportunity to partner and collaborate with them to support the pan-India startups in educating them and getting them ready for their funding and other strategic needs during the growth journey. We'd also like to thank Bangalore Tai, who is our co-host for today's event. I'd like to take this opportunity to introduce our keynote speaker, Jeet, along with our other panelists. So Jeet Vijay is the CEO of Mighty Startup Hub. He comes with over 18 years of experience across private equity, venture capital, and strategic management. Before taking this role up, he was the Assistant Vice Chancellor in University of Texas and the MD of Horizon Fund under the university. Welcome and thank you for being here today, Jeet.
Thank you, Hormuz. Appreciate this opportunity.
We also have amongst our panelists Joshuita Ravi. She's the principal at Arali Ventures. She manages the analytics, AI, data ecosystems, as well as plays at the retail tech investments she looks after. Welcome and thank you for being here, Shweta.
Thanks, it was a pleasure to be here. Nice.
Then we have two very interesting startups, and I'll just introduce both of them. We have the co-founder and CEO of Hirex, Ujin Dreshwara Kudupudi. So basically, he is running a very interesting AI-based recruitment tech platform that is automating level 1 interviews using voice-based bots. Welcome and thank you for being here, Eugene.
Thank you, Hormuz, for the introduction.
Yeah.
Glad to be here.
Then one of our the other key panelists with us is Sachin Sahani. He is the founder and CEO of Keros Superfoods. Sachin is a serial entrepreneur from the fitness and wellness domain. His recent startup, Keros Foods, is India's first brand for diabetic-friendly super snacks and superfoods. Thank you and welcome to the show, Sachin.
Thanks for the opportunity, Hormuz.
And finally, we have Vijeta, a well-known figure in these circles. He is the executive director of TIE Bangalore. For those who don't know him, he has worked in various sectors, starting with the hospitality, retail, and co-working spaces. He's committed to grow the startup ecosystem, and he's one of the most approachable people I've seen in the startup ecosystem. Thank you and welcome, Vijeta.
Thank you, sir. Thank you very much.
Moving on, I would like to invite Jeet to share his thoughts on what MSH's vision and goals are and how are they helping in shaping the startup ecosystem in India. So over to you, Jeet.
Thank you, Hormuz. Good evening to all the attendees here. I think we have a really good showing. So I think it speaks to the caliber of the panelists that you have assembled here, that you have got quite a good showing of attendees. And they're really interested, I think, both in the panelists as well as the topic today. You know, when we think about investment, I think it's such a critical facet of the whole startup ecosystem because, you know, making a product and making a company and actually figuring out how to monetize it. And to be able to monetize something, you need an upfront investment to go into building it up. And how do you raise money? Who do you raise money? When do you raise the money? What is the right money, right way of raising it? All these are very tricky questions. Because not all money is good money, right? Do you go for a financial investor? Do you go for a strategic investor? Do you look for rupee capital? Do you look for international capital? That will define a lot of things that you start to look at. And that's why we are really excited to partner with MergerDomo. And because one of the things that we do at the ministry, Mighty Startup Hub, is to figure out how do we build an ecosystem for enabling and accelerating our startups. So to give you a little background on MSH, so this is a nodal agency set up by the Ministry of Electronics and IT to support startups, be it in their IPR, filing, be it in their incubation, be it their investment, fundraising, and anything that we can in terms, especially in the deep tech areas in electronics and IT. So for instance, we are supporting 51 odd incubators currently, 26 center of excellence in deep technology. So be it AR, VR, blockchain, robotics, drone technology. So we have set up center of excellence focused on those. Also, multiple accelerator programs are being run, and we provide significant funding to startup over its lifetime. For example, our funding ranges from EIR, Entrepreneur in Residence grants, which is at an idea level. This is even before an entrepreneur forms a company. Then we provide product development and prototype funding for entrepreneurs to actually do the technical feasibility of their idea. Then we provide commercialization funding of up to 40 lakh rupees each to startups to commercialize their product. And just last week or a week and a half ago, we gave 44 different startups up to 40 lakh each for this scale funding, for this commercialization funding. So all these funding is under our Tide 2.0 scheme. Aside from that, we have a scheme called Samrid, which is more focused on building the accelerator ecosystem in India. Because we have 50,000 odd startups now, third largest startup ecosystem. But making a company, a startup is one thing, but how do you scale it up? How do you make it economically viable and scalable? And hence we are more focused on accelerator ecosystem development and working more with private sector to bring its scalability and expertise in terms of how do you take companies from 5 to 50 people, 50 to 500 people using systems, structure, processes, and setups. Aside from the scale funding, we also provide hyper growth funding through Electronic Development Fund, which is a fund of funds set up by the ministry, and it is being managed by the Can Bank. And the goal of that fund of fund is to give funding to VC funds, SEBI registered VC funds, to invest in electronics and hardware oriented startups. So literally everything from the idea level to the hyper growth level, there's funding available from the government. But at the end of the day, we realize that the government funding is just a part of the story, right? It is to de-risk the technology, it is to validate the idea, it is to ignite the ecosystem, but it is not really there to scale the companies and realize the profits. For that, you really need the capital markets to work. You need the capitalistic mentality and orientation and philosophy to come into the play. And hence, what we do is we work with the private sector quite a lot. So, and that's the story of MergerDomo and MSH, is engaging with funding platforms and experts who are committed in their lives and their companies to helping startups find that right source of funding. And not just money, but helping these startups become fundable, right? Because everyone comes and says, hey, I want to raise money today. I know, even I wanted to raise money when I was very young. I still want to raise money, right? You never have enough of money, right? So problem is never with the money, it's what we do with it. That's where the problem lies. But to be able to raise the money, you need to know investor communication and everything else that goes before it. How do you make a pitch deck? How do you make your valuations? And I think that's where the expertise of Harmuz and his team come into play, is making startups fundable, helping them understand their shortcomings, positioning themselves in the right way, which allows them to present themselves most effectively to the investors, which increases the probability of getting funded. And that's why I'm really glad to be having this partnership with you guys, and good to be on this platform today. And really looking forward to hearing from the panel their views. I think we'll have a very interesting discussion with a very diverse set of individuals with a lot of interesting backgrounds. So thank you so much for this opportunity, and look forward to hearing from you all.
Thank you, Jeet. Thanks a lot. I think very interesting things you mentioned, and for the audience, I think it's a good takeaway that MSH is here to help on the both sides, even the startup side. It is, and they have so many schemes right from seed stage to scalable startups. They want to grow and handhold the entire ecosystem. He also mentioned on the other side, for the investors, they have a fund of funds. So even investors can take benefit from the schemes that they are running. So I think that is a very, very good takeaway for both sides. So thank you very much, Jeet. So I'll now start with the panelists. And I'll request the audience to post their Q&A, and we will take it up. Gaurav and I will take up the questions once we finish the panel discussion, and happy to take it your questions up. Shweta, I'll start with you. You coming from investor, VC background. What are the economics of fund investing as per you?
Okay. So this for me is a very interesting question because I came from a very different background. I came from 15 plus years in a corporate world. So when I walked in and I heard, okay, how VCs invest, in my head it was like, oh, they're looking for this huge one company, two company, where everything has to be a success. And then I got and I realized that's really not how the VC numbers work. They are very simple. Let's look at the 80-20. We want one or two to succeed. The rest is what it is. So I'm going to give a little bit of numbers right now, so you might have to listen to it a little bit more intently. Unfortunately, I don't have like a whiteboard to write down and scribble down my numbers. But if you look at a typical VC, how it works, say it's 100 crore a fund, and we are talking about 20 investments, you make 5 crore each. We need at least to make a 4x for the overall 100 crores. That's a basic minimum requirement from a fund point of view. Now we can look at it as two ways how it breaks out. One can be that, I have the 4x returns coming from all my companies. So take 50% gives me 4x, 50% gives me 3x. So I'll get about 250 crores and about 150 crores are coming from, just the 4x, 3x. So that'll give me my 400. That's okay, good. But how a VC works is completely different. We are looking for the huge, big ones that have to come. We're looking at the unicorns. We all want the unicorns to come into play. And so when you're looking at that, we're actually looking at, say, two guys making a big shot. One guy give me a 50x returns. The other guy say, give me a 40x returns. Now I'm making 450 crores out of just these two guys. That's the fundamental we look at. The reason is how we, like mentality, what we're looking at, how a fund and how the money comes back to all the guys who are investing in the fund really comes when it works like this. So good businesses is good, but great businesses is what a VC really looks for. And unfortunately, or fortunately, that's how it works. It's looking at saying, okay, those at least 2 out of my 20 should click. The rest, it's okay how it filters and goes through.
Okay. For the benefits of the startups that are hearing this, how are the investment decisions made? How do you actually decide for a go, no go?
Okay. So there, let's look at it this way. One is the business-based decision we make, and the other is the people-based decision. From a business point of view, first thing we look at is what is the market size? Is it big enough? Can your company grow? Can it have competition and still be a good big firm out there? Second thing we look at is how quickly can your business grow? Can it be that rapid growth one that just reaches and beats? If it's a B2B, how quickly can you make your first 10 guys come into board? If it's a B2C, how quickly can you get 10,000, 20,000 users in? Those become critical factors we look at. And then we're also seeing, okay, what is your moat? What is this unique thing that you have which can give you an edge over what your competition has? So these are the basic things we look at, especially when we're an early stage fund. You're looking at these. Now, the other core thing is as important, if not more important than just the business, is going to be the team. It's very critical for us that you get good promoters. You got to show passion. You got to show amount of resilience required. It's not easy to run a startup. You got to show you're going to take the grit, go through all the headache that's going to come by running it, and still stand by it. I mean, if you look at a lot of the big guys, people say, oh, Apple, Google, Facebook, I want to be the next big one. Sure. I'm from India and we had Orkut before Facebook. And we all knew that. But if you really looked at it, then suddenly Facebook came, and today Orkut is like, my parents teaching me about Telegram. It's like what that was. Not the app. For the new age people, it's not the app Telegram. You're using the older day Telegram. But that's kind of how it is. So the team, the effort they're ready to put in and how they're able to stand is equally important because it's not an easy world to survive.
Okay, so coming from the team point of view, many people ask, should it be a single person or should it be more than one co-founder? And, is there a average, do you judge the experience? So, again, a lot of freshers today are taking the entrepreneurial jump early on. Should they do that? Or you're like, no, get some work experience and then do, what is your thought on that?
It's a double-edged sword, I'll tell you honestly. Sometimes we say, oh, we want the youngsters. They're the ones to take the risk. So we want them. And at times you'll say like, no, not the ones who have the experience, don't go by anything. Go by what you believe in. I think that's what matters. And whether it's a single or having multiple entrepreneurs, it's always better to have co-founders because it just balances out things for you. As a single person doing everything,
Yes.
it's hard. It sounds good and cool to say I'm a single founder, but man, and at some point you're going to figure out how do you handle work and your personal life and everything, and then you just drown yourself. It's always better to have somebody around with you to help you out.
Okay. I'll just place this question to the startups also on the panel. Eugene, Sachin, any one of you, any of your thoughts on this thing that you should be a single, or you felt, I should have had a co-founder? Any one of you would like to answer that? You're on mute, Eugene.
Yes.
As a person,
Sorry.
yeah, please go ahead, Sachin. Please go ahead.
No, please, Eugene.
So as a person who has experienced that, I can tell you, my first startup, I was a bit impatient. I was not willing to wait for people to join me, and I did my first startup. And it crashed and burned in exactly 14 months. So it's very important. That's when I realized it's very important that you, as a single person, doesn't matter how good you are, entrepreneurship is a team sport. And you need at least 2 to 3 people to basically support.
And maybe complementary skill sets.
Exactly. So it's not like, okay, you are a good developer. That means you don't need other skill sets. You need skill sets like somebody who's good at sales, somebody who's good at talking to bankers, somebody who's good at talking to vendors. So you need all types of complementary skills. Just to not think that, okay, I'm good at coding, I can write an app overnight, and then that's it. I don't need it. So now you need people with complementary skills. That's very important. And that's the learning I took it to Hyrex. And in Hyrex, we have like 3-4 co-founders, 2 co-founders, and another 3 founding team members. So that basically helped me in driving. We are close to 2 years now and making early revenue. That's the difference that has brought when I brought.
Thank you. Yes, Sachin.
So I very much agree with both of them, both Sweta and Eugene. So what I'll add to this is, yes, you need multiple co-founders to be able to, handle various aspects of the business. But be very sure when you're looking for a co-founder, whether you really gel well. Otherwise, I tell you from my personal experience, if the co-founder is there with you, not for the passion or the real, passion of the business or the solving that problem that he's there, and only for money, chances are you will not gel well and not for long. So I'm sure Sweta and other VCs like these would always be looking for whether these guys together gel well or not.
Sure.
And I've seen a lot of companies go bankrupt or the businesses go out of track.
No, absolutely. I've seen a lot of energy going waste for one of the founders when this happens. And it's a double whammy for him: run the business or sort these issues. Thanks, Sachin. Thanks, Eugene. So I think that's where so Sweta mentioned scalability, speed, moat, promoters. So Sweta, how should startups be pitching based on this thing?
So I think the first thing that the startups should do even before they approach a VC is ask yourself the question, do you really need a VC? You are going to spend a lot of time and effort talking to each one of us. It's not, oh, you pick up a call, we have a call, done, you get the money. No, it's a very nice way to think it'll work that way, but it doesn't. So do you really need the VC money? Next, do proper research. A VC guy your decision of whether they want to go with you or not, it starts with the first conversation. So you need to say, okay, why do you think they should put the money into you and not the person they're going to talk in the next 30 minutes? You have to be able to say what is unique in there. How do you bring about that disruption you want to for the industry? How do you face what is there? How do you understand the market? What is your knowledge? What is your strength? All these have to come about. And in a very personal note, I've noticed sometimes that, startups go through the whole day talking to VCs. And if you're talking to some of the VC guys towards the end of the day, you can see the tiredness in them. And that shows lackluster for the person who's listening to you. don't do that. Go take a shower, have a coffee, whatever. But make sure, irrespective of which time of the day you're having conversations, you're bringing out your A game, your passion, and make sure you know your numbers. It is up to you to know your competition. It is up to you to know your numbers. If as a VC we ask a question and we can figure out easily if you're fudging it and you're just fluffing it at that point of time, you're going to lose the interest of the.
Absolutely.
That's very
Absolutely.
important.
Sure, sure. No, in fact, you're very, very, very right, Shweta, because we see, so many startups coming on our platform. We're always telling them that first step is preparedness. Don't be in a rush to go to the VC angel, because you see, you're going to get one shot. He's not going to entertain you again. That one shot is so critical, but yes, yet there is that need or urge ki nahi jana hai, and let's go with half-baked data numbers. Valuations are completely at times something which is very critical, that the startups over here also should need to understand that it's very important to know your valuation and not get swayed by what is coming in the media over there. Okay, thanks a lot, Shweta. Vijeta, you're in the marketplace perspective, you see both sides of the coin. Startups also come your way for investor connects. Investors want to tap your startup network to invest in fresh startups. So you would have seen many successes and failures. What would you like to tell entrepreneurs when they are getting ready for investment?
Sure, definitely. I think I will take the takeaways that have come from various people. See, for example, what Jeet said also, no, be investable, work towards that, have a great team, make sure that your product is perfect. Shweta saying, get your numbers set, don't fudge anything, do your market research, know exactly what is the solution going to do for the people who have problems and will pay you for it. So we just want to focus on that, and thanks to MergerDomo and all you wonderful people, there's a lot of resource sharing, insights, and networking that is happening. Okay, and networking is not just about finding a customer or an investor, right? You also need to see who could be a fantastic co-founder, because we talked about this as well. Like if you don't have a co-founder, you're going to be struggling. So you must get a very good quality co-founder. And why should a co-founder come to you? I think today's most elusive person is a CTO. And I think entrepreneurs should understand that these CTOs command massive salaries, and why shouldn't they make money? Because they slog, right? They put in so much of effort. So think about all these factors also. You need a great startup team. You need people who will have your back. You need people who will, of course, your legal, your financial structure, and nothing I'm talking about here getting you investor connects. Okay, I'm taking a slightly different take here, because that will come to you. Investors will find you. Investors are also looking, right? It's not that investors have money and they're going to sit on it. They want to deploy their funds. They want to make money out of it. They want to make money out of you. They're betting on a winning horse, right? They want to make sure they back you up. They help you with more investor connects, more customer connects. So I think what we really need to do is, as enablers, as ecosystems, we want to do more. We genuinely care for everything that we can do for these wonderful entrepreneurs and startups. And also from the fact that it's going to create a lot of employment, Humzad. I think that's very critical for our country, at least, right? We need a lot of employment. We need a lot of patents to be filed. We need to make sure that these grants that are coming, for example, guys, Government of Karnataka, the Elevate program, tomorrow is the last day. Please apply. It's a fantastic opportunity for you to get your 30 lakhs or 50 lakhs worth of grants. You are a member of TIE, we'll help you with the mentoring. We have Gaurav and team over there from MergerDomo. They have so many fantastic tools which will help you to get what you need to know about your startup. So if we can create more and more of these innovation clusters, and Humzad, we are going to be doing all these sessions and series over the next few months. I think we can add so much of value back to the founders, and to the founders, spread the word out, peer-to-peer networking. There is nothing like it. Too many times you all don't pay enough attention that you all chase the wonderful investors who want to give you money, but maybe you all can also learn from each other. So that's all I want to say, and I'm now going to go back on silent. Thank you.
I have one more question for you, Vijeta. Thank you. I think those are good points, and I think these points will come back to those. But share some of the best practices, from your journey, for entry and exit for both the entrepreneurs and from an investor perspective.
Sure. So see, we have a lot of our charter members are also from the investment community. And then we also have many successful entrepreneurs who have not only grown their startup, but many of them have had exits also. And they're onto their second and third venture. So one thing is they've timed it well. And I think that's very critical. There is no ego on this. If for whatever reason, because we do know what has happened because of the pandemic, a lot of wonderful people running fantastic startups, because they were in the wrong industry at the wrong time, they got hammered very badly. So they tried to pivot, but they couldn't manage. But they cut their losses and they did pivots. And there were others who realized that they were really doing well, and maybe the peak will come down. So might as well get your exits done, give it to someone who can take it to the next level. They can scale it up beyond where we are today. See, because whatever said and done, you should not be killing yourself, right, Homzan? It's, I mean, you have your family, you have your friends, you have your own health. So don't do anything. And this is a very personal thing I'm telling, right? I don't usually talk about this, but don't do anything that will destroy your, health, your family life, or whatever else you want to do. It's very important to take care of yourself and your immediate, circle. Take care of your people. And
yeah, go ahead.
So exits will happen. You got to keep your relentless networking going on, however busy you are. You must not stop being approachable, because if you sit on your high horse or in your ivory tower, the right person might be trying to reach you at the right time, but you are not being able to understand that, and whatever. So whether it's an investor or a startup, stay reasonably approachable. Keep an eye out on the market. Do your research work. And when it's the right time, don't think like, okay, if I wait for a little bit of time, I'll get 10% more, or I'll whatever it is. Get out when you have to.
No, in fact, so many we've seen that timing is so critical that you have the term sheet one day, the investor is free to walk out the next day.
Yeah, exactly. And that's happened. We keep hearing about this, right? People backing out because sentiments changed, or someone sneezed in London, or something happened in Dubai, or whatever it is.
I'll bounce this to Sweta for her opinion.
We don't do that.
They're good people.
No, but in all honesty, it does happen. It is no two ways about it. It happens. We've seen this happening, and even from our own portfolio companies, when we go for the next round, we've seen this happen a lot. And I completely, agree with what Jay is saying, that this timing, everything will come. You got to figure out how to balance your work life as well. It's so critical. You don't want to burn out yourself for just making that few extra $1 million or whatever and spend it in the hospital.
And I think over here, again, going back to the team, again, if you have a dependable team, so much so then you will not burn out yourself to that level also, I think. So again, it kind of stitches, the story stitches in that sense. Sure. Thanks, Vijeta. Eugene, coming to you as a startup who is raising funds currently, and I think there'll be a lot of people in the audience who would be at this stage. What are the challenges you are facing right now from a fundraising perspective?
That's a great question, Humaz. So actually, I would say right now, I feel compared to 10 years ago, when I was thinking of entrepreneurship and I was trying to raise some fundings compared to now, I feel right now the ecosystem is far more mature now. Houses like MergerDomo and others, in fact, we are part of T-Hub Lab 32 program. They help us a lot in basically trying to make sure that our business is running right, make sure that the matrix is set up right, and then basically be a startup that is investable. Okay, so all of this is pretty good actually. But having said that, one thing I have observed was most of the funds that get developed in India, at least, is, if you see, right, most of them are growth capital. But risk capital is also equally required. For example, MeetY and Startup Seed Program is trying to address that, where even if you have a simple idea, they're ready to give 40 lakhs, 50 lakhs. And believe me, that money is very crucial for a startup.
It's like oxygen.
Yeah, that's oxygen. So the risk capital is coming. And believe me, any entrepreneur who's planning to start at this time is really, really lucky to have an environment where they're getting that risk capital. So once you get that risk capital from places like MeetY or the Startup Seed Program or a university grant program, okay, that's all risk capital. You should then concentrate on how to make your startup such a way that it can attract growth capital, where VCs and other people can basically invest. So compared to that, right now, risk capital, only 10% people are there. I think I wish it grows to more than 30, 40%. That way, a lot more people can come into this ecosystem and provide employment opportunities.
Sure. So I think that's very true, because we also on our, on our platform, we're having over 400 investors. there's a lot of growth stage, but also early stage. But very few are ready to take that risk on MVP stage or operational stage. But I think that's because as a country, all of us are going up the curve, so we can't blame anybody, for that. But tell me, what about in terms of when you're raising funds, do you get asked or having a challenge on go-to-market strategies? Is that a big challenge, for the audience benefit? I think that's a very critical point where typically everybody wants to know how will you grow. You take the money, but is it planned out? Is that feasible? Any thoughts there?
So basically, if you see, like most of at least 70 to 80% of the startup technology startups that come mostly are led by engineering people. I myself, as an engineering manager all my life, and I was a technical person all my life. Transitioning from an engineering role to a business role is a very important journey. And as you said, the first question that a lot of people will ask is, what is your GTM strategy? In the early days, I didn't even understand how to answer it. I was like, what is there? Okay, I have a SaaS service. I'll put it on the cloud and people subscribe it. That is my GTM strategy. What else is there? That's not that. That's not what's the answer for that particular question. It's basically they look for a structure of your thought process. Exactly. When they say GTM process, how is your sales channel coming up? How is your marketing channel coming up? Okay. If a particular feature is not working out, how are you understanding that it is not working out? So all these strategy, all this particular word called GTM strategy is so important that a technical founder like me should understand and spend a lot of time. Talk to people in the industry. Being an entrepreneur doesn't mean that you have to know everything that is there. It is okay for you not to know a few things, but more importantly, ask people who know about this, take advice from them. If it is possible, pay them, pay mentors, take a mentor, pay them also. Nowadays, it is not so costly. People do take a small fee and then give you a very good advice that can save you at least a year or 2 years of your journey. So it's very important that you work on your GTM strategy. That is one. And more, apart from your GTM strategy, your business model also is very important. Like, what exactly do you require? You should have a clear understanding. What exactly do you require to basically make sure that the revenue streams are established? Revenue streams realize money out of the work that you do. That's very important. So your GTM strategy and your business model canvas should run side by side. In fact, what I normally do is I take a printout and put it right in front of my computer, and I basically watch it every day. And you should always have those papers and then see every month they keep changing. And if you keep observing the past 6 months, you'll understand how your thought process also basically goes through.
Right.
And more importantly, listen to your customers. Whatever GTM strategy you have, it's good. But listen to your customers, what they say, yes. And based on that, you basically, charter your course with respect to GTM.
No, absolutely. I think listening to the customers is very important. But I think I like to take that point of yours that listen, and if we don't know everything, it's good, it's okay. But the part where you mentioned about getting experts, I think that's something which the younger lot needs to understand. That even at MergerDomo we have over 150 consultants. So, and today the elder generation is saying, look, we want to give it back.
Exactly.
So these guys are there waiting to give their 40 years of experience. Here you are the startups, you're like, okay, I have a founder, co-founder, but what next? I have an idea what to do. There are a lot of innovative ways, as Eugene very rightly said. Maybe affordability is an issue. This guy will charge me the moon, but no. For the benefit of the startups, I would like to mention they are even willing to take a bet on you from a sweat equity point of view.
Exactly.
So do that. Look around, talk to people in your circle. Ty is there, we are there. There are, in your circle, you'll just have people. And they're ready to help. So I think that's a very important point, Eugene, you enter. But Shweta, I'll bounce it back to you from a business model, GTM perspective, if you can give your perspective to the audience.
So GTM is extremely critical, but it depends on which stage you're looking at. So if you look at a very early stage, it's the worth of GTM is also to understand how the founder is thinking, how their understanding of the market is, and how they want to solve it, and how they want to approach with the solution they have. But sometimes at a very early stage, you also notice that their GTM idea might have to be flexible as well. You can start, you'll go into a market, and then somewhere down the line, you realize, I got to pivot. This is not working the way I want to. And that's also something we're okay for. But if you get to the later stages, like you're hitting the seed, the pre-series A, series A and stuff like that, but then it's got to be solid. By then it has to be set up, kept, and that's what's going to give you the numbers to show your worthiness for the next few rounds.
Okay, so what you're saying is for the early stage, it should not be so much of a stressful event for the startups that, if my GTM is not right, I'm doomed.
Yeah, because usually the early stage VCs are also okay to help you and handhold you to guide you to where you should be going. But it's necessary that you have one. You cannot just go say, I have an idea and I want it. You should have a GTM plan, but you don't have to fret too much if the GTM plan you had is not working. You can always figure out your path and way to do it. That's what I'm saying.
Sure. Thanks. Eugene, one question: how flexible have you been while raising funds? Have you, for example, valuations? It's always a very tricky thing, and a lot of startups are pretty stuck at certain numbers. Have you sensed that you need to be or should have been more flexible during a fundraise round?
So the first time when we rose funds were from friends and family. These are HNIs that I've known them personally because I worked under them or I did business with them. You don't believe it took me 2.5 months to just arrive on a valuation when I didn't have any sales. I barely had a decent team, but we had a product at that point of time. So it's very difficult to basically evaluate a product at that point of time. And when you start off, right, you feel like you are the next $1 billion company. Okay, you really have that Josh. But over a period of few months, you'll understand what exactly is that $1 billion worth, and you keep tapering your expectations. So in the initial times, yes, we had a very tough time. You have to be very flexible. People say, I say it is $100 worth. People will say it is not even 1 rupee. So don't take it too hard. Okay, people talk based on their experiences, and you listen to them and come up with a fair number. So when I said 100, people said it was 10. Okay, I said okay, fine, 10 is fine. Let's start with it and then move forward. In the early stage, be a lot flexible because you want your idea to launch. Okay, you don't want it to crash and burn at the launch pad itself. You want it to launch. So be a bit flexible. And once you go to a certain stage where you keep getting early revenue, you yourself will understand what is the worth of your startup and what kind of revenue projections you can do for the next 6 months, 12 months, or 24 months. Based on that, you can do it. And right now we have a lot of nice instruments. For example, if you take Y Combinator as a safe instrument, that is one of the best I have seen till now, where right now the investor need not worry about your investment valuation, but rather he will worry about the valuation at a later point of time.
Absolutely.
So there are a lot of wonderful instruments like that. Explore them and then take it forward.
Sure.
Some VCs agree with you, some VCs might not agree with you, but you can always sit down, talk to them. VCs are very friendly. End of the day, they want to deploy their money. It's not like they want to put it in a bank and earn some interest out of it. They want to deploy this money. So they will be flexible. They will listen to you, but you should be also reasonably good.
Thanks. In fact, yes, you pointed out, rightly that the market is maturing now in terms of instruments also. So for the benefit of all the startups that are here, I would definitely, I've seen that especially for the seed and the angel stages, now, there are these convertible notes, CCPS instruments, which allow you to talk to the investors saying, hey, do you like my idea? Let's talk about the idea.
Exactly.
So if you like the idea, fine, because then valuation is put aside, pegged to a later stage, giving a discount. So that's a technical issue. But the good news is there are people who are looking to invest in you and not so much worried about, what is the valuation. So there would be such people. But Shweta, I would like to bounce it off to you. That is it even happening at the later stages? Because typically, I have seen that early stage, yes, this happens. But once you're at a, maybe pre-series A, then by that time you would expect that the valuation should be around. So would someone look at a convert structure at that stage also?
Pre-series A, you do have a little bit of the convertible note idea coming into play, but going beyond, it's not that common. It's more rare.
Right.
It's the pre-series.
The valuation should have some benchmark, either operational metrics or financial metrics.
It will have it. It becomes necessary. It's a part of your basic calculations and how you value.
Absolutely. So again, I think for the startups in the audience, if you are at an early stage, pre-revenue, this is good news for you.
Very much.
Of course, you have to do a lot of research, do that homework, and
exactly.
we're there to help out.
Yep.
Okay, thanks. Sachin, coming over to you. Now you're at a stage where you have raised funds, you're raising the next round. So interesting times, challenging times. So tell us, what all sources did you tap during your fundraising?
Look, I think from my personal experience, I would suggest to the startup founders out there, start early. Even before you need money, start much early. And the hacks could be, what I did was I kept posting about whatever milestones we were achieving or the achievements that we were having on our social media, LinkedIn, and that was one. So at least your friends and family know that you've been doing a good job. So whenever you would actually look for money, they would be out there to support you. There's a credibility already built in there. Two, I on LinkedIn especially, I followed a lot of VCs, early stage investors, angels. Send them look. We have a physical product, unlike a software. So we would send them our festive gift hampers. So at least they know, and without any saying that we have any motive there. We just want to wish you, and if you eat, we are very sure you will keep repeating our purchase. That's about it. So these kind of things, they help, really help. So you start building up that credibility, the visibility, and when you actually need it and you go out there, half the job is already done. So that was one approach that I tried. And of course, then, I also sponsored one investor conference. That was also there. But there are, these are the things which I tried out at least.
Did you also think of tapping an angel network during those days?
Yes. So when you are, apart from friends and family, reaching out to investors, sending your gift hampers, that's part of the job. Half the job is done. So the moment I was ready to raise investments, when I sent out some notes to the investors out there, I got my success there.
Okay. So why don't you share your learnings? So when you had that success, what did the investors ask? What were the key points, before signing the term sheets? Any anecdotes?
Oh, look, valuation thing is one, which, they've already mentioned. So I think early stage, one should not really worry about valuation. I think CCPS, CCD instruments are there. You should be, very comfortably. You should, on the first go, you should agree with those. And if you're looking to raise funds fast, then raise funds fast. Don't worry about valuation in the first stage. And another thing that I would really, really like to recommend all the startup founders out there, raising investment is a science in itself. It's a long process. It's a strategy. If you are a first-time founder, you cannot get it right. So take it from me. 99% of chances you may not be able to plan your investment cycle very right. So hire an expert, maybe approach a accelerator. There is help available out there who can professionally plan for you. This is very important, I think. And as far as what people, the VCs or the angels ask is, depending on the maturity of if it is friends and family, they invest on your face. If you've been doing the right things, if you have a success story behind you, they'll invest on your face, on your credibility. When it comes to the VCs, early stage, at seed stage, it's ideally, what is the problem that the startup is solving, how big that problem is, and how dire the need is. And of course, how big that market can grow. Can this VC who's betting on you very early on, or the startup network like MergerDomo, can they make money? Can they make 4x, 10x? What can they make? And again,
Shweta said 40x.
so my personal thesis here is not every investor is made for you.
Absolutely.
So there'll be all kinds of investors. So there are some who are impatient. They'll not match with your kind of industry or the theses they have. So we don't need to fret, and we should be happy accepting no rather than chasing the wrong investors, I think.
No, I think that's true. But I think it's a challenge, no? Such an initial stage, it's difficult for the first timers to know that this guy is going to be a pesky investor later on.
That's why I said it's very important. Either hire an expert who can plan this thing, or get on board a mentor or an accelerator or something like that. I made this mistake. I decided it a little late. So I would not want the founders out there to take this decision later than now.
Okay.
That's true. That's true.
So I think I'll just add on another point on that, is because again, for the benefit of the startups in the audience, wearing these two hats is a challenge: running the business and continuously looking for funding. So did you have a strategy that one round is done, now for the next 1 year I'm not going to look at money, I'm sorted, and now I'll look at the round next time? Or you're like, I need money all the time, and how was that thought process?
That's why I said, if you have multiple co-founders, one would chase investors only. You must do that. Otherwise, get somebody on board who can handhold and help you on that. Because लगता है कि अभी धंधा करें, again start chasing the investors, and then they don't have simple demands. They would ask you 10 things, or rather 100 things. ये भी चाहिए, वो भी चाहिए, and right now. So every investor would want it right now, and then you would have a call to make with an customer or a dealer or a big timer there, and then you start juggling between one or the other. So that's why I would again suggest to the founders out there, have a professional help out there for planning your investment cycle, and for times to come. This will help you if you start early with a professional help.
Fair enough. I think we've got excellent answers from all of you. I think we'll, I'll stop asking questions now. And I think considering taking the time into consideration, I think we'll take some audience questions. So Gaurav, if you can help out over here, I think my chat box is full of like some 50 questions, 40 messages. So.
Sure. I think there were a couple of questions from the investor side. If there are any concerns if husband-wife pitches to the VC, and is it necessary to be a private limited, or it could be a proprietorship?
I guess I'm taking this question. So first, the husband and wife part. Do you want to take it up? That's up to you guys. You see each other at home, you're going to see each other at work. So that's a challenge. Having said that, no. And I have personally, I've noticed too. One, you have a husband and wife where, unfortunately, it's mostly the wife who's kept naam ke vaase kind of a thing. But keeping it as a serious relationship, this is where, when I say we talk about the founders, we really will start to dig in, because it is very important that we have the founders gelling well. And when it's a spouse relationship, it's not a no-no, but it's something that definitely will have the investment world looking into very seriously with, magnifying glass to see, is everything really okay? And can you guys take the burden of being co-founders in the same company and run your household and do everything else? So that will be something they will definitely look at. I wish we didn't, but we will. What was the other question, Gaurav?
It was for, should it be a company or a proprietorship?
Doesn't matter, I don't think, at this point. If you're going in very early and you still haven't figured it out, it should be okay. You find the right kind of investor, figure out what their preference is, and go with it. I at very early stages, do not break your head on that.
And also another thing is on edutech.
Mhm.
Are there any VC funding for B2B startups in education industry, and what are your perspectives on that?
So edutech, yes, absolutely. We, us included, we look at the B2B space in edutech. What you do have to figure out, as you would see, the B2C part of edutech grew massively during this COVID period. So it's a good time to be a part of the edutech, get in and try to get some funding. It's a perfect time for you guys to do that. With respect to B2B, it's who is your target? What is the kind of solution you're bringing to the schools or colleges or whichever institution you're looking at? And how quickly can you get the number of institutes? And that's what's going to be important, because with COVID slowly fading off and now the expectations of everything to start opening up, it should still stay relevant, it should stay critical, and the adoption rate should still be high for you. That's something you'll have to figure out and work primarily when it comes to tech. Hope that answered your question.
I think there's one question that has been asked is that how do we get the professional help in investing? So I think Sachin, put it up pretty well that, you need to look out for experts. These are called by different names. They could be called investment bankers, they're financial advisors, they could be mentors. And so there's plenty of help. There could be accelerators who are at early stage. As Jeet mentioned, there are so many handholding which they are doing from the government side. So yeah, but primarily if you can get one or two advisors for yourself who would know the whole investment journey, and then that is something which would really help you out. I mean, at MergerDomo, that is what we are continuously doing. We are a group of investment bankers. We've digitized what we're doing offline. But yeah, there are many advisors. Look around and you will find one. Gaurav, any other questions?
Yes, there is one specific on social ventures. Any special advice for social ventures that are for profit? Should they be going through other routes? Are there any grants? Any other probabilities? Please advise.
Gaurav, this is for Shweta.
Shweta or Vijeta? Please.
Shweta, you start, and I can pitch in, but please go ahead.
So I was going to say you do have multiple options to look at. And when you're going to VC, there are specific VCs that kind of cater and look at social benefit companies. So I would really suggest that you start, do your homework, find out the right kind of guys who will invest in you. In today's world, there's no shortage of the different kind of people who are ready to invest into this. So that's where I was going to start off, which is that you can absolutely add more into it.
Yeah, sure. So because we talk to founders all the time, understand the investment thesis of the VC or the whichever firm that you want to go to. All this is public knowledge. If you just search on it, you go to their website, you'll also see their portfolio. You'll see what is the profile of the people out there, so you know their backgrounds. And number one. Number two is very critical, which I also spoken about before. Talk to the founders who are part of the portfolio of those VCs. They will be able to give you a warm introduction. They'll be able to give you a lot of insights, and that will really help you. So these are the two factors that I think you all should look into. And there's no shortage of networking events. There's no shortage of webinars that are happening. But do your own research work, do your own due diligence. And I think before that, let's go back to what Shweta also said, right? Know your numbers well, prepare well. I think that's more important. The investors will find you. Don't worry about it. There are plenty of people out there. You have platforms like MergerDomo. So I think that's what I would say. Thank you.
Also, just to add to that, I think, like you're saying, there are lots of grants that come into this. So don't go just jumping desperately to find VCs. Use these grants to really build yourself into something that looks very enticing for these kind of VCs to get in. So that's definitely not something you should let go if you're getting grants and such things. Absolutely take it. Use any money that you can to build your company better. I would definitely suggest you do that.
I think our experience is that a lot of angels are also looking at this, because there is a lot of buzz around the 17 UN sustainable, SDG goals. So a lot of investors are aligning themselves amongst those 17, whatever is personally, they like something or that cause, they're taking it up. So this is happening even at the angel stage. So keep an eye for, those UN sustainable development goals also. See if you are aligned to any of those, then look out for certain networks for that area.
Actually, World Bank and USAID and Asia Development Bank, these people regularly advertise about the grants for social clauses. I think people need to keep an eye on them. I think they have a central website. I don't exactly remember that, where all these grants keep coming in and you can apply for that. Especially if you're a scientist from a scientist background, I think it's a lot easier to get such kind of grants.
Shweta, there's one more question, and I think this is a very, very interesting one. Do you insist for all co-founders to be full-time into the startup if they are currently using job finance to fund the startup until they raise funds? I think it's a very valid question. What is your thought?
No, again, since this is going to be an early stage. So from an early stage, it's the commitment part that comes into play. It's not the reason why we look for full-time guys is because there is that commitment that you're promising for the company. It's like I said, having a startup is not easy. It is extremely difficult to believe you'll be spending time here and there and everything. Everyone will be looking at you saying, okay, you got to deliver something to the end. That's kind of the reason. So no, we will look at you guys. I don't think the VC world immediately says no, but there should be absolute commitment from them. And there has to be a belief that we are able to trust that, once you get the money to get these guys in, they will get it. It should not be that, okay, take money and you decide, no, we won't get it. So yeah, that's how it should be.
And there's another question that again asked to you, that we have good advisors on board. Would that be a no-go for any investors, since they will be biased views from advisors and from VCs?
No, absolutely not. It's good to have advisors. None of us are experts in everything. It is always good to have advisors. It's good to know that you aren't going to go with your blinders on, and it's not going to be only your point. You have people who understand what they're talking about, they're guiding you, and you'll follow them. So no, it's absolutely good to have advisors always.
Absolutely. In fact, I personally, at MergerDomo, we realized the importance of advisors, and right from day one, we've been trying to bring in industry stalwarts based on their expertise, and we've been offering them sweat equity.
Yeah.
Because obviously we're not able to afford their hourly or daily rates, and they're very eager to join, as I had mentioned earlier on. So it's good to have them on board. Okay, another question is that what is your say about investors who look for equal shares and promise to take care of further rounds so that there is no further dilution? Is it good to go for startups?
This is a dicey question for me to answer, sitting on this side of the. A very honest answer is, if you're going to give away 50%, make sure you are getting everything worth for that 50% you're losing. That's the honest to God truth. Yes, they can open doors, you can do, that's where you can have use of advisors, you can have your early stage VCs helping, you can have friends, families, your contacts, your co-founders, everybody can come in to start doing that. So, and you should also remember, the moment you start diluting 50%, when you're going to the next round, you have only 50% less to get rid of. So do you want to take that risk? Personally, it's a huge thing you'll have to decide on. It's not, I don't even know if I should say from this other part. You're saying, no, don't probably go for losing 50% of it, especially for early stages. Because any VC, anybody coming in, when we invest into you guys, tomorrow when I take the next round, I'm going to be diluting money as well. And we're very quickly calculating and saying, you either have nothing or we have nothing. Somebody's going to have nothing at the end of it. So, yeah, think really hard before going into such a huge dilution.
I think for the paucity of time, we'll take one last question. And it's a valid point, for the young, startups that he's asking, can the founder ask for his or her monthly salary in the business funding plan? So,
Me? Or okay.
yeah.
Absolutely do. You can.
Yeah.
You should.
Absolutely.
You should.
Yeah, you
Absolutely. Absolutely. In fact, this is
just to add a little, but don't go back saying I earned 50 lakhs in my job and I want 50 lakhs. That doesn't work. What
I was
you
about to
do,
say that.
get a salary that makes sense. But yeah.
So I'll also add here, yes, you should ask for your salary.
I think all of us are doing that because it's a very simple funda. You have to run the kitchen and you have to keep yourself motivated. So no investor can say, no, you work for free, you have equity, so no money. No, that won't work. But yes, you have to be reasonable in your ask. I think all of us over here would be at maybe a fraction of what we were at the corporate world. So that is, I agree with Shweta, that can't be taken.
Let me add another important thing, Humas, to it is what Shweta said, that yes, you have to take, but it should be a reasonable amount. And that is a valid idea because, see, let's assume that your corporate world paid you 50 lakhs and you pay only 10 lakhs for you right now. Think that 40 lakhs that you're leaving on the table, it's going into the business. It is going to create more value for you rather than you take it home. You put it in your business and let the business grow, and ultimately your equity value also grows with it. So think it that manner that, okay, don't think that I'm charged less. Whatever money you're leaving on the table, it goes into the company and that will develop your equity further.
And I think these calls, those people who are, sitting, in their jobs, it's very important to know your cash flows, your liabilities, because before you take the plunge, you must understand the risks that will come along. So if there are liabilities, that should be considered and then factored into the salary also, which again cannot be a very fat package. So the cash flow has to be taken into consideration because ultimately it's a leap of faith. We don't know what is going to happen ultimately. So I think at that point, I would thank everybody on the panel. I would like to thank all the audience for being good listeners and a very interactive session. And thank you all our partners. Thank you, Jeet, once again. Thank you, the panelists, our partners, MSH, KTech, KDEM, TIE Bangalore, Jito, Gain, 100 watts, 10x2, AIM BIMTech, AWS, CIMI, Founders Institute, Cosma, everyone. I mean, I'll take this opportunity to thank everybody. Any closing remarks from the panelists? Happy to hear them out.